Welcome to the Rose Show podcast.
Welcome to What Does the Fed Decision Mean for the Market? Discussion with Michael Kramer of Mott Capital. Thank you for joining us this afternoon. We hope to make this space educational and lots of fun. Quick disclaimer. Please do not construe this as investment or financial advice. I'm Rosanna, your host, and I'm here with the fantastic Michael Kramer. In this space, we will discuss the Fed's decision today, the market's reaction, and what it means for the market going forward. As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. And that is what we hope to accomplish here as we decipher Powell's announcement and its meaning for the market. So let's begin. Michael, is this what you expected today?
I was very hawkish going into this. I was expecting a 75 basis point rate hike, but I will admit their dot plot was even more hawkish than I expected. And anyone that's been following me now knows that I've been very hawkish for months, and I've been very much in the camp of they need rates to go much higher, and they kind of even exceeded my expectation a little bit.
Wow, I would call you the hawk. So that is pretty impressive, I have to say.
Yeah.
When I was listening to him speak today, it just reminded me of Jackson Hole. To me, it was like he took the Jackson Hole speech and just rearranged it a little bit. I mean, he still made the same points that it's the central bank's responsibility to make inflation low.
Right.
He wants to avoid entrenchment.
Right.
He does not want us to have expectations of high inflation and that to become entrenched, because then we based household and financial decisions on high inflation being the norm and wage and price settings on that. And he's going to keep at it until he's done. And he was very firm. He was pretty consistent saying he expects below trend growth, softening of labor market, have a balance of supply and demand. And he wants to bring inflation down to 2%. He wants to at least see that it's moving, have clear evidence, and he's not shifting from that. But what did you think of Powell's tone? I know you just said that it seemed even more hawkish. Do you think there's any possibility of him wavering, or you think he's really means business?
No, I think he means business, and I think the truth of the matter is he's meant business for some time. But the problem was what happened in July. They gave the market an inch and it took a mile, maybe 3 miles. But he, I think, learned his lesson. He seems to learn his lesson when the market reacts. And the same thing happened December of 2018, if you remember. I remember him kind of talking and the market was tanking 3% with him just sort of talking in the background because it didn't like what it was hearing. And so July kind of served as that example as well. The July and August move higher. But, even a couple of the reporters, or at least one of the reporters, tried to, get him to kind of go into that, we're going to pause camp. Are you going to pause? Are you going to pause? And he just said, he just kind of he wouldn't budge on that. So, the big thing is that I think they are very serious. And I think the market wasn't believing him. But between this and Jackson Hole, I think it's very clear now where they stand and where they're going.
I agree with you completely. Absolutely. I think he's trying to make that point across. And I agree. There was a reporter I think a few of them actually just kept rephrasing the same question about, could there be a pause, or is there any way we can just hold off and wait? And he was pretty consistent in saying that he's going to keep at it until it's done. So absolutely. Michael, I love your charts. You compare the tip with the QQQ, and, your charts are fantastic. And I hope everyone goes to Michael Kramer's profile and checks out his charts. He does fantastic comparisons. And also you write at Seeking Alpha and you discuss those comparisons, which I love. And that's how I originally met you many, many months ago. So what do you think about the market's reaction today?
So it was kind of funny because and I mean that in from like an observational standpoint, because and it was actually very telling, having been a trader for many years. The market was set to get a big rip, and it did get a big rip. After that initial downdraft, we ended up rallying and going to a new high on the day momentarily, which was almost a 2% intraday move. And then we began selling off into the close. And what I think became pretty clear to me as I was sitting there watching it is that there was a lot of implied volatility melting like I expected to happen, but there was so much actual, I think, natural selling flow that I think it overran the implied volatility run up that we saw around 230. And that's what sort of took over at the end of the day. And I think that could be very telling in terms of what comes next, which may be the new lows that I've been sort of looking for.
Brilliant analysis. I love that. Could you just explain a little more? I see your chart from 3 hours ago, and everyone can go to Michael Kramer's site profile page. It says SPX IV is over 100% for today's ATM craziness.
Yeah.
Could you just explain that a little more for everyone, please?
So that chart was showing you the intraday movements in implied volatility for an at-the-money S&P 500 put or call. And basically, going into the Fed meeting, implied volatility for the options today, we're trading at over 100%. And those are, I can't recall a Fed meeting, even recently, where you saw that much implied volatility baked in to option pricing. And so when the implied volatility is very high, it makes the value of your put or your call higher in value. And then when implied volatility begins to decline after the event, those put or call options begin to lose value. It tends to, in this case, affect puts more so, which would attract put sellers. And as people sell their puts, it should help to lift the market, because market makers have to sort of unwind all their hedges that they have in place against the puts that they're technically, they sold to the customers. And so when implied volatility gets that high, that's what led to that big 2% sort of intraday move off the lows. And that was what that chart was was suggesting, that you could get a big move up when that implied volatility started to come down.
Brilliant analysis. Yeah, so that's sort of like what we see during uncertainty, during earnings reports and other times when you have a major event. You have a higher IV, and then after the event has ended, you can have the IV crush, they call it. So do you think that will be happening today or tomorrow or anytime soon? That IV you anticipate coming back down, correct?
Yeah, it's already started to come back down because, clearly today's options are obviously expired. And then actually, if you just give me a second, I can check and I can tell you where it already, when I was online earlier today and looking, the IV went from like 120 today to about 50 tomorrow. And as of right now, IV is for tomorrow is expected to be 40%, and that will decline as the day goes on. And then for Friday, it's expected to be around 36%. And then by Monday, you're back sub 30. So it's going to disappear very, very quickly. So whatever opportunity there is for some sort of what I call a Vanna squeeze, or an implied volatility melt, is going to vanish by the time you get to Monday.
Excellent analysis. Thank you so much. And that's what I love about you, Michael. You have a great eye for spotting these type of uncertainties, and with high IV, which is symbolic of that, and exposing that. So thank you so much. And yes, by Monday, it should be vanished, all that excess IV that we saw for this big event today.
Right.
Yeah. So, I love your bond yield discussions, and there's been a lot of chatter about bond yields, and a lot of people may be a little confused. And I was on a space earlier today where they were just not understanding why the 2-year was so high and the 10-year not, all these different discussions. So I would love it if you could explain to all of us the bond yields. And I'll phrase the question like this. We see the new cycle high for the 2-year yields hit over 4%, I think 4.1. And the 10-year yield is now down a little to 3.5%. The inversion is at about negative 0.5%. And the 3-month yield is at 3.29%. Could you please tell us your thoughts and explain what is going on here, please?
So the 2-year, I've been arguing now for some time that should be over 4%. Based off of what the Fed projections are today, it could be as high as 4.5%. Because all the 2-year is basically doing is mimicking and chasing the Fed fund futures higher. So if you kind of look at the contract options for the contracts for the futures of federal funds rate, right now they peak at I'm looking at my thing. They peak in now May at 4.61%. And what the 2-year is basically doing, it's latched on and it's looking 2 years forward, and it's looking at the December 23 contract, which right now is trading at 420. And so it's trading at a little bit of a discount to that December Fed Fund future contract for 2023. And basically it's just following it higher. Now, what's going to happen, I think, is that the 2-year yield is going to start rising up towards that 4.5% range over the next couple of weeks, maybe a couple of months, until, once it becomes clear that that's where the Fed is going to go. And it seems like that's where they're going as of today. And then eventually you're going to start seeing the 3-year rise, the 5-year rise, and the 7-year rise. And they're already close to 4%, but I think they're going to continue to move higher. And the same thing with the 10. The reason why the 10-year yield, I think, is sort of where it is because there's been this sort of, I guess there's two things going on. I think there's been a disbelief that the Fed is going to be able to do what it says it wants to do. And the other piece is that the Fed is not only not going to be able to do what they say they're going to do, but that they're going to put the economy into a recession. And so therefore they're going to have to start cutting rates. I'd argue that, yes, real GDP has been negative for 2 months, 2 quarters in a row, and we're probably going to get a third quarter negative print too, because it's barely positive at this point. I think it's 0.3%. But when you look at measures like gross domestic income, which is another measure of the economy, the Fed looks at very closely. And I know this because I've heard Chris Waller mention it. He's on the Fed board. He's mentioned it in several interviews he's done where they talk about the GDI still being very much positive. And when you average GDP with GDI, they're still positive. So even though you're getting negative real GDP numbers, you still have an economy that's growing, and you have a nominal GDP growth rate that's at nearly 9%. And so what I'm getting at here is that despite all the rate hikes the Fed has given, the economy on a nominal basis is still growing very, very quickly. In fact, if inflation is at around, call it 8.5%, and we have a 0% real GDP growth rate, that would imply that nominal growth is still growing at 8.5%, right? Because to get real GDP, you just take nominal growth and subtract off your GDP price index. And the GDP price index usually is in line with CPI. So what that's telling me is that despite everything the Fed has done already, the economy has not actually slowed. And so this idea of the economy actually going into a true recession hasn't really taken place. And so therefore, I think you're going to see that spread begin to contract with 10 years rising faster than 2s.
Wow. Excellent. Brilliant analysis. I love it. I love how you bring in that GDP and nominal growth and being as high as it is. And it's an important point. And how would you distinguish that nominal growth from the real growth?
Well, so nominal growth is think about it like this, right? when a company reports results or they have revenue, they're reporting the revenue. They're not reporting it adjusted for inflation, right? So it's the same concept. We have GDP that's just sort of what it actually is. And then we have GDP that's been adjusted for inflation. And so what's happening right now is that you have nominal GDP growth growing at, let's say, 8%, and you have the price index growing at 8.5%, and then you get a negative real GDP print of negative 0.5%. So nominal growth is just what the actual growth metric is, where the dollar values are in absolute terms. The price index just adjusts for the pace of inflation, and the real number is the adjusted for inflation number.
Great. Thank you so much for explaining that.
Sure.
Now, thank you, Michael. Do you think the Fed can bring down inflation to 2% as they want, or as their goal is? Powell said that the core would be close to 2.1% median and 225. Do you think that's possible when looking at all these variables, or do you think we may be in a new level of inflation, maybe 3% or higher?
So I want to believe that they can, but I've been looking a lot at the actual price index for the CPI. And, we look at it, we get numbers in terms of monthly and year over year, but no one actually reports the actual value of the CPI, right? So it just looks like a chart of the S&P 500 to some degree, but it's more linear. And it almost looks like, if you kind of look at it, and maybe I'll post a chart on this later on my profile page for everyone to see. But when you actually look at a chart of CPI itself as an actual index, it's interesting because it almost looks like a snake, like going from the lower left to the upper right, like kind of swerving in and up and down, and right now there's been a very noticeable bend higher in that curve, almost at an exponential pace, almost as if it's trying to return to the mean. Meaning or mean reversion. So, you go up on a linear line and you can go above it or below it, but at the end of the day, you're always kind of hovering around that mean. And that's exactly what the chart looks like right now. It looks like it's going back to the mean. So it's almost like we were undershooting inflation for too many years. And it's almost like now we're going to be in a period of high inflation for a number of years. And we may overshoot to the other side of it. I don't know if the Fed's going to be able to this point, the last 2 or 3 months, they've stopped. The index has literally gone flat in its tracks. And again, I'll post this later for everyone to see. But again, the question is whether or not they can do that. The index has never done that before. And the only time the index has declined is when we've been in a recession. So the Fed almost needs to induce a 2008 style recession. In other words, the Fed needs nominal GDP growth to go to below zero in order for the CPI to fall. And right now that's talking about going from an 8% nominal GDP growth rate to below zero, which is a huge amount.
Agreed. Absolutely.
And that's sort of what you need to bring that index down to actually have a negative, or, get that inflation rate to get to that sort of 2%, and they can kind of reset it from there. Otherwise, they need to grow. Otherwise, they need GDP to be. They need CPI to increase at a 0.1% monthly rate for the next 12 months, and that will get you a reading of under 2%. I don't know how they're going to do something that controlled, but so that kind of suggests to me that they have a very difficult task at hand.
Agree. Very difficult task. When they infused money into the economy during COVID with no labor, no production, that was going to be issues. We had an unfortunate pandemic, but at that point we have like a monetary inflation. We have all this excess money supply. And so there are a lot of issues and a lot of moving parts here.
Well, and the other thing that's interesting, though, that I think a lot of people overlook, it's not really just the monetary policy side of the things. It was the monetary policy plus the fiscal policy that was enacted. The $5 or $6 trillion of spending that was done to sort of keep the economy moving, which was really meant to be like a stopgap to keep the economy from having, going broke, right? And keeping people with money. But basically that physical spending, which the Fed enabled by buying the bonds that the US government issued, is what really, I think, drove a lot of this.
Exactly. Thank you so much for that. That's so true. So that's why we have a lot of issues ahead. And in time, things will work out, but it will take time. Do you have an idea? You think so? 2.1 median in 2025, that will be challenging. So you think it could be a possibility of a higher new norm then, unless things all the stars all lined up in the proper direction.
Yeah, I do. I think we are in sort of a new norm. I mean, and I think unless they can get the economy, and not just the U.S. economy, you really need a global sort of reset to occur. I think it's going to be very difficult because, I fell into this trap like in October of last year. I saw the price of oil coming down. I immediately thought, oh, oil's coming down, inflation's going to come down, because that's been the relationship for 20 years. And I learned the hard way in the fall of last year that no, that relationship isn't working anymore. So there's something else going on in underneath inflation, whether it be housing prices, whether it be food, whether it be services. There's something going on beneath the surface that goes beyond what we've all been kind of trained to look at over the last 20 years, things like commodity inputs. And I think it's gone beyond that now. And so it's becoming a much more difficult thing to measure.
Great. Thank you so much. Now we look at, and Powell did mention the Fed terminal rate, the future rate, and he said probably about 4.4% before at quarter one. So between 4.25 and 4.5%. Do you really believe that they will hike another 125 basis points before quarter one? Maybe 100, like do it a 75 and 50 or a 50 and another 50 or something like that?
If you get more 8% inflation prints, it's probably going to be higher.
Wow. So you think that they can go that high and we could get another 125 basis points if the data does not improve in the next PCE or CPI?
I mean, by the end of this year, you can do, technically, if they did 75 and 75, you could go 150, right? But if you keep getting these 8% inflation prints and they don't start coming down on CPI, the data shows that inflation doesn't really break until you get rates above the inflation rate. And we have an inflation rate of 8%, right? Go back to the 70s and 80s. I posted this chart before too, and I'll post it again. But the only time that you really saw inflation start coming down was when they got the inflation rate, they got the interest rate on the 10-year above the inflation rate, and it held there. And then basically as inflation came down, they reduced rates as inflation rates fell. And so, 4.25, if we got lucky enough to just stop there, I would be happy, because with inflation running at 8%, if it doesn't start coming down soon, rates are probably going to have to go even higher than what the Fed is projecting. And yeah, I think it's very possible that if you get an 8% print in October and a 8% print in November, they're going to go probably 75 and 75.
I love your brutal honesty and your harsh. It's such a great reality check because it's just so refreshing. Powell did say we're at the lowest level for the restrictive policy. And he actually used the words, we have a ways to go.
Well,
so wow.
And that's the other thing. They don't really know where the neutral rate is. They're just guessing. But if I were to guess, I would say that the neutral rate is higher than where they think it is. Wow. And I don't know where that is because they don't know. I'm not going to know. But I would guess by the way the economy is responding, that it's it's higher. And I learned this another lesson the hard way too, is that these ISM and PMI data points are very, very important to follow, because I think that they actually reflect the economy better than what all the other data points do. Because I noticed that during the pandemic, when the data points were telling us that the economy was a disaster, the PMIs were not telling you that. They were actually telling you the economy was actually fairly strong and pretty healthy. And I would look at the data and go, how is this possible? How is it possible that the ISM services data are telling us that the economy is as strong as it is? And sure enough, it turned out to be right. And so I really pay very, very close attention to what those ISM data points are telling you. And the services and the manufacturing data also both tell you that the economy is still in expansion with positive values. So that's another reason why I think the neutral rate is higher than where the Fed thinks it is.
Great point. Love it. PMI, ISM, very important reports that we should be watching. We should only be watching CPI and PCE. Agree, absolutely. And the recent ISM, we saw that their supplier deliveries were down, and we have major supply chain issues still going on. And Powell did reference that, and he's saying they're starting to improve. Hopefully they are. He also mentioned commodities have peaked. Do you agree with that? Do you believe most commodities have peaked?
You know, it's an interesting question about supply chains and everything. I'm going to try to find this data really quickly, and then you can maybe give me an answer, what you think. So what the interesting thing is, if I go to nominal GDP and I go up on the Fed website, if we were to look at the last 5 years, so going into the pandemic, the U.S. had a nominal GDP, not adjusted for inflation, $21.6 trillion. Do you know where that number is now? You want to take a guess?
I don't know. I'm not a guesser. I would say a lot higher.
Yeah, it's so we went from an economy with $21.6 trillion a year, or that's what the GDP was in the fourth quarter of 2019. Today, that number is 24.9 trillion. So the size of the U.S. economy grew by more than 20% in, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In 10 quarters.
Wow.
We went, from 21.7 to 24.8. So $4 trillion on 21 is like a 20-ish percent, almost 20-ish percent growth rate in nominal GDP. So I guess the question is, do we really have a supply side problem, or do we have really a demand problem? In other words, is supply really sort of normal, but because so much demand was created from the growth in nominal GDP, supply couldn't keep up?
Love that point of view. You hear that, everyone? Honestly, Michael, you're amazing. I think we vote you for Fed chairman. You're fantastic. I know. No one wants that job. We don't want that job. Okay.
No, thank you.
He can keep it. Okay. Well, I have to say, I think that what we're all wondering, and what's all on our minds, is what does this all mean for the market going forward regarding rising positive real rates, bond yields rising? What about the ERP, the equity risk premium, and the SPX valuations and prices that need to come down? Could you please describe all that and explain that and what you foresee for the market going forward, please?
So very quickly, I'm at the point where I'm kind of letting the bond market tell me where the equity market should go. And that relationship that I continue to follow is just looking at the TIP ETF every single day. I just watch real yields. The higher real yields go, the more I know the NASDAQ and the S&P 500 have to fall. It's really just that simple. And then if you were to look at if you look at the NASDAQ sort of earnings yield versus the 10-year TIP, I mean, the NASDAQ today, if I pull it up really quickly, has an earnings yield of about 3.45%, meaning that the ERP, the NASDAQ's earnings yield is 3.45% higher than the 10-year TIP rate, which is 1.15%, right? So, but historically speaking, that ERP is at a level that has only been seen one other time in the last 23 years, almost 25 years, back in the sort of August of 2009, after we got past the peak and everything. And essentially, what that tells us is that the ERP, which is sort of averaged around 4 to 4.5%, means that the current ERP at 3.45% is about 100 basis points too low, which would indicate to me that the NASDAQ earnings yield should be 100 basis points higher than where it is right now. And all you do to figure out what that means in terms of a PE ratio is you would take you do 3.45 plus 1.15, which would give you an earnings yield of 4.6 right now. And that's like a PE ratio of 21.7. And then you add 100 onto that, so it would be 5.6. 1 divided by 5.6. 1 divided by 5.6 is 17.8. So you got to take off about four handles on the PE ratio to get back to like some sort of average ERP. Does that make sense?
Wow. So yeah, absolutely makes sense. So where would you say the NASDAQ is then right now? The NASDAQ's price needs to come down. So what would be about the ballpark price point for the NASDAQ so that the ERP will be
that's 18,
average
about 18% lower.
Wow. Okay, that's what I've been reading about. People are saying 15 to 20% lower. So yeah. Your math calculates like always.
That's just to get us back to the average, though.
The average, exactly.
And the average where we were trading basically before July.
Wow.
So if there's actual like a widening of that spread, that ERP would have to go much higher, and the earnings yield of the NASDAQ would have to go much higher. So right now, that spread has been contracting. But again, the ERP, for example, during the COVID crash hit 5.4.
Wow.
So, it's going to depend on where rates go, but there's been a disconnect between the market and real rates over the last couple of weeks, where real rates have been rising very quickly. NASDAQ, although it's been going down, hasn't been falling fast enough, resulting in the ERP contracting and making the NASDAQ more expensive on a relative basis. And so I would expect that spread to go the other way and to begin to widen. And the more uncertainty there is in the market, the wider the spread should be. Think about high yield bonds versus treasuries. Think about the spreads between high yield debt and treasuries, or high corporates and treasuries. Those spreads have widened, right? And so equities aren't really all that different in some ways. And those spreads should widen as well, not contract.
Exactly. And for the SPX, and that is usually a wider or narrower ERP than the QQQ.
Well, so the NASDAQ usually trades at a higher valuation, so the spread is usually lower on the NASDAQ. For the S&P, I don't use the 10-year real yield. I use the 10-year nominal rate. I don't know why. It just seems to work better, and I tend to get a better view. But if we look at the S&P earnings yield minus the 10-year rate, right now it's 2.4%. And again, if you go back, a number of years, you're talking about, a valuation that you don't hit it until the summer of 2009 as well. And, currently at 2.4, that's low. And, we've averaged something like 3.5. Going back 2020 to 21, and going back really from 2013 to 2018 and really up until the
Yes.
pre-pandemic level. So, I mean, again, you're talking about maybe 100 basis points of widening that needs to take place just to get to the average.
Yes. So you would say SPX is currently trading about 20, maybe it can come down another 18, 20%, just like QQQ, or is it different?
Yeah. I mean, basically, I mean, my view has been for a while now that the S&P 500 is going to probably test that 32 to 3,300 range, which is about 14 times earnings.
Wow. Well, I have to say, I learned most of this stuff from your Seeking Alpha articles. If anyone wants to learn more about this and have how Michael explains this all, he has some fantastic Seeking Alpha articles about this. And it's specifically about the 10-year with the SPX, and it's a 2.4 ERP spread. And you go into all of this.
Yes.
So it's right on Seeking Alpha. I love how you explain it. It's fantastic. I mean, this is like, in 2020, we never even thought of the bond market. I mean, we just didn't even think about it. It wasn't even a concern. And the reason why I bring this up is that we're here to help, share knowledge, experiences, and educate. And many traders started trading around the 2020 period. And so they're not familiar with how important the bond market is. The bond market does not lie. And it's a great indicator for the equity market, exactly as you said, and I agree completely. Thank you so much for everything.
Thanks for having me.
You're brilliant. I have to say, absolutely. You guys, Michael is brilliant. He's my go-to on all bond yields and all this stuff.
Thank you.
It's fantastic.
Thank you.
Yeah, you're great. And so I think that about wraps it up. I mean, we wanted to be quick tonight. We just want to give everyone just a little post-Fed, analysis, just to explain it, simplify it a little bit for everyone. If there's anyone that has any questions, we could take one or two questions if anyone has any. Do I see anyone? Maybe we answered every question possible. So, okay, that's good. So, Michael, do you have any other last things that you'd like to mention, or any ideas or final thoughts?
I think that this is very much a market where you just have to be patient. You can't rush to chase it in either direction. And I think you really have to rely on a lot of what bonds and the dollar are telling you. And when you see bonds doing something and the equity market doing the opposite, you need to really think hard about that and why that may be happening. Because I think the bond market understands a lot better than equities do what is going on. And so I think that those should be your kind of defaults in terms of checking. And I think the TIP ETF is the easiest way to keep track of real rates. It's such an easy way to do it. When the TIP is falling, it's an indication real rates are rising, which are bad for stocks. And when the TIP is rising, it's an indication that real rates are falling, which is good for stocks. So when you get the stock market going up and TIP going down, probably not a good thing.
Great. And could you advise everyone the best place to look up for the current TIP rate?
Just go into TradingView or your Yahoo Finance, wherever it is, and just type in TIP. It will pull you the TIP ETF. In terms of following real rates themselves, they're very difficult. But the Fred website does post them every day, once a day, and they're usually so like if you go to Fred, which is a St. Louis Fed website, and you go in and you just type in like 5-year real yield or something, they'll take you to that, and then it will show you what the real yields are. Or if you have TradingView, you can use the DFII. And it will show you a list of about 5 or 6 different types of real yields you can track as well.
Perfect. Yeah, I like to use Fred. I use that extensively for all types of data.
It's a great resource.
But that's great resource. Yeah. Absolutely. So thank you so much for everything. Make sure you follow Michael on Twitter, Seeking Alpha, and his YouTube channel.
Yes.
What is that? Just Michael Kramer? Is it Mott Capital or?
It's under Mott Capital.
Okay,
that's been my
Mott
new venture.
Capital. Okay, love it. I'm subscribed. Make sure you subscribe to Mott Capital. because you want to know what Michael Kramer has to say. His analysis has been on point with how he deciphers all these numbers and everything, and I love your charts. So stay tuned. We will have another space with Michael in October, I think the beginning of October, and we'll be talking more stuff, more fascinating, cool stuff.
Sure thing.
So, yeah, absolutely. But thank you, everyone, for joining us. We were so grateful to have you as listening. Hopefully you learned something today. Thank you and have a great day.
Thank you. Bye.
Bye-bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.